And as we were talking before we started the recording, you're 30 years old.
Yeah, more than that.
And you've got an AUM of some 30,000 crores, and
Yeah.
that also includes the acquisition of IDBI Mutual Fund.
Yes. People are there from private sector everywhere, whether it's IT, it's investment, sales, investor services, across departments, compliance, risk. And it's like any other professionally managed AMC at this point in time.
How has the bond market received that 5.1% number, and what are the expectations generally on bond supply for FY25? I mean, I remember, say, 10 years ago, this used to be a major number for the bond market when things were still not as developed as they are now. But here we are, 1 year ahead, 5.1%. How are things looking? Folks, welcome to Paisa. I'm your host Anupam Gupta, B50 on Twitter. And on today's episode, I'm really thrilled to host for the very first time on Paisa, LIC Mutual Fund. My guest, Marzban Irani, Chief Investment Officer, Fixed Income at LIC Mutual Fund Asset Management. We are going to talk about debt funds, interest rate cycles, and much more, especially how you can make a strategy for your debt fund allocation. Mr. Irani, welcome to Paisa. Thank you so much for doing this for our listeners.
Thank you for having me here.
It's great to have LIC Mutual Fund. Hopefully, I can actually have LIC also someday. But please explain to our listeners what exactly is LIC Mutual Fund and how it's different from LIC.
So, LIC Mutual Fund, as you mentioned, is LIC holds stake in LIC Mutual Fund. We are a subsidiary company. And but one thing I just wanted to mention that LIC is a private sector mutual fund. Not many people know about it. And all the people across departments are from private sector except for the CEO. So there are some reasons to that. The CEO who comes from LIC has a varied experience. He has worked at different places, and when he comes, he brings that experience on the table. And people are there from private sector everywhere, whether it's IT, it's investment, sales, investor services, across departments, compliance, risk. And and it is managed like any other professionally managed AMC at this point in time. We are more of a process-oriented organization. As I can just say, from the fixed income point of view, we follow certain processes for our investments. We follow the SLR philosophy, the safety, liquidity, and returns philosophy. Safety is of paramount importance on the fixed income side because people come for that on the debt side. So we do a detailed research of each and every papers that we invest into. We have a separate research team which looks into that, and only after the credit committee approves, then we go into any invest into any papers. And like the research guys not only look at the outside rating which is given by the rating agencies, they do internal rating themselves for each and every paper, and only then we take those type of decisions. The second thing, the L part, is the liquidity part. So we look at the liquidity of each and every paper, whether we are able to liquidate, because we are a pass-through vehicle. So that is also very important. And risk-adjusted returns follows after that. So this is the philosophy that we follow at LIC Mutual Fund. So basically, it's a process-oriented fund. For equity also, we have certain processes. That is how we invest.
And as we were talking before we started the recording, you're 30 years old.
Yeah, more than that.
And you've got an AUM of some 30,000 crores, and that also includes the acquisition of IDBI Mutual Fund.
Yes.
Very interesting. So let's start with what's been happening in the debt mutual fund sector. Okay, I think it's going to be now 1 year since the indexation benefits were taken away last year, and 1 year has gone back quite quickly. How's it been? How have flows been? How have things changed?
Indexation was surely a cherry on the cake. I would say it was a very important thing. I think for retail investors, it would have really helped if this would have continued for a longer time for the growth of the fixed income markets. But having said that, earlier people used to invest for, say, 3 years because of this indexation. Now they come more of a tactical call kind of a thing. They come for a year, in a year when, the interest rates are probably going down, when they can benefit out of it. So it will be more of a tactical kind of a call now as we go ahead. You see, it's about asset allocation. Fixed income is you can't put all your money in equity markets, or you can't put all your money in fixed income markets. So it's all about asset allocation. So each and every individual has to think what amount of asset, depending on his risk appetite and his tenor of investment, which asset class they want to invest, how much, what percentage they want to invest, and take a call. So indexation is gone. but fixed income will be there. Will continue
Always,
to be
yeah,
there.
of course. Let's talk about fixed income, debt mutual funds a little bit more in detail, because there was always this talk about how India has a massive amount of money lying in fixed deposits, and some of that should definitely shift to debt mutual funds. So that's first. Second is what you correctly said, which is that debt mutual funds should be part of a portfolio. And that's very different from looking at it as a tactical call. So how has this category of debt mutual funds evolved for the retail investor? For institutions, of course, it's been a major thing from day one. But for the retail investor, has the story of FDs to debt mutual funds been playing out? How is that coming along?
So see, FD has always been, parallelly moved along with the fixed income schemes. However, now as people are getting, educated, there are certain things how fixed income schemes are different from FD. Like if I do a 1 year FD and I need my money, say 3 months down the line, the bank is going to put some penalty. They are not going to give me the same rate that was expected. So FDs, whereas in case of mutual fund, you can just come in anytime, walk out anytime. There is no penalty. So that is one important thing. Most important thing in one word I can say is about transparency. Every fortnightly, mutual fund puts up the portfolio on the site. So if you have invested, say, X amount in a Y scheme of a XYZ mutual fund, you can go to the site every fortnightly and you can check where your money is getting invested. Whereas if you put that money in a bank FD, you don't know where the bank has lent that money. So there is a transparency here. Every fortnightly, you get to see that. And one more thing I would like to say is that suppose if you come in a growth option, suppose sometimes what happens, we do a 1 year FD and 1 year down the line, we feel, no, I don't need the money today. Maybe I could have done a 1.5 year or a 2 year FD. So then you have to do another FD. So, but you end up paying the tax because there is a TDS on FD. Whereas here, if you enter into a growth option, you can just stay invested. The day you need money, that is the time you come out and you pay the tax. So you can delay that tax outgo for that period, and only when you come out, that is the time when you redeem your money. There also you can do it through a systematic withdrawal plan and gradually withdraw your money. So from a tax efficiency point of view, so transparency, tax efficiency, and the penalty. These are the three things I would.
Liquidity, I would say to that. Liquidity. I mean, every time that someone looks at a fixed deposit and especially now in the last, I would say at least 2 years when the RBI has been hiking rates, FD rates have been going up also.
Absolutely.
People just keep on taking an FD thinking that they've got the peak, and then again they realize all that can easily be taken care of in a debt mutual fund.
Absolutely.
Much more efficiently, more liquidity, tax efficiency, everything.
Absolutely. Whenever I talk to media, I tell them this is your responsibility. You know, more and more people should know this, so that I'm not against any FD or anything. I personally don't put my money in FD, but this is one way out. I mean,
so I think the message is, folks, don't buy and don't invest in an FD because you want something like debt mutual funds, and don't invest in a debt mutual fund if you want something like an FD. Both are very, very different asset classes, investment classes. Okay, Marzban, let's say someone is listening to this episode for the very first time and he wants to understand debt mutual funds. Okay, sometimes even I have grappled with certain concepts because I've always been an equities person. So I want to talk about a description of debt mutual funds at two levels. First, let's start with the concepts of duration, accrual, and I think appreciation. These are the three main ways in which you can make returns in a debt mutual fund. Once you've explained that, then we'll get into the type of schemes. Okay, so please.
So coming to duration, without going into the technical part of it, modified duration is what one needs to see at any point in time. Basically, with a 1% change in the interest rate, what will be the impact on your portfolio? Suppose my portfolio has a modified duration of say 7 years, and it has an inverse relationship with interest rates. Suppose the interest rate goes up, then the price of my bonds will fall by 7%. Suppose if it is 7 years, and the reverse happens, 7% increment in the portfolio. So that indicates, modified duration indicates what will be the volatility in the portfolio. That is why it is put for the investor at a scheme level. That is what he has to see. What is his risk appetite, whether he can bear that volatility or not. If they can't take volatility, say a duration of 2 or 3, go in a short-term kind of a fund where the duration is lower. There the volatility will be less. So with a 1% change in interest rate, your portfolio will move by 2 or 3% because your modified duration is 2 to 3 years. So that is the concept of mod. The other part was the accrual part, which you were telling
I'm going
me.
to stop you there. So, folks, just to repeat that, duration is the number of years in your debt mutual fund, the category in which you're investing. From what our guest has told us, the longer the time frame, 7 years, 10 years, the more the fluctuation is possible in the NAV of your scheme.
Yeah.
Okay. And the shorter, like we talk about ultra shorts, liquids and all that, then less will be the volatility, if I've got that right.
Right,
Accrual,
absolutely.
please.
So accrual is like assuming nothing happens in that 1 year period. If you are invested in a fund which has a high accrual, you buy into, say, a lot of high yielding papers, and it just remains constant. Say your 10% is the limit. Suppose for simplicity you have 100 rupees.
Correct.
So 10 rupees, 10 papers you buy in the portfolio, the fund manager buys, and all are at, say, for simplicity, at 8%.
Yeah.
So at the end of 1 year, you are going to get that 8%. And suppose the expense ratio is, say, 25 basis points. You minus that, you get 775.
Yep.
That's your accrual in short. So nothing happens over there. There is no volatility. There is, more or less. So sometimes people who don't like volatility or who don't want to take that duration call, they go for this accrual type of schemes that I'm happy with this portfolio. It is just giving me a constant accrual, more like a FD kind of a situation. So that is a thing. And I think the last thing you talked about is capital appreciation. So that is the very important thing. You asked the right thing at this point in time when we are in a falling interest rate scenario.
Correct, yeah.
So suppose my scheme today has a duration of, say, 7 years and modified duration of 7 years, and interest rates are going to fall. So I will not, and my YTM of the portfolio, the yield of my portfolio is, say, 7%.
Yeah.
And say there is yields have fallen down, say, by another say 50 basis or 75 basis. So when the yields come down, your price appreciation is there in the bond prices because there is inverse relationship. So that appreciation that you get is the additional gain that you get is your appreciation. So you get 7% plus you get that additional appreciation, say 1 or 2%. So your total return at the end of the year will be, say, instead of 7, it will be 9, because 7 you're getting your constant YTM.
Yeah.
But over and above that, you are getting some additional because your yields have come down in a particular year. The reverse happens when your yields are rising.
Yeah.
So your YTM might be 7% and you are getting capital depreciation at that point in time. So that will reverse the 7%.
Yeah. Just think of it in a simple way, folks, that if you've taken an FD at 7% and you wait for 2 years, and after 2 years a brand new FD is just 5%, that 7% looks much better, right? Now in a debt mutual fund, the FD has a capital value also to it. It's not an FD, it's an investment, and in general, capital values and interest rates move in different directions, which is that NAVs go up when interest rates are going down. It's in simple terms, okay? Okay, great. So can we talk about products and schemes now across the spectrum? Let's look at it, in terms of duration, because I think that's an easier way for people to understand, starting with the shortest of duration and going all the way to long term. Just please explain that.
So this is a beautiful thing which SEBI has done. Like, I joined mutual fund industry in 2000. It's been almost 24 years, and this is the most important thing which SEBI has done. The segregating all the products. Yeah. So suppose somebody wants to invest for a day, there is a overnight fund. Then there is up to 90 days. There is a liquid fund. Then 90 days to 6 months is a ultra, and then from 6 months to 1 year there is a low duration. 1 year to 3 year there is short term. So they have segregated products based on the duration. There is if you go long, then there are gilt funds and bond funds at the longer end. And dynamic is the only category. The name suggests dynamic bond fund. That SEBI has not said anything. You can, it's run very dynamically. There is no cap on either side. But at other funds that I mentioned, there is always a cap. Suppose like short-term bond fund is 1 year to 3 year. You can't go below 1. You can't go above 3. So that's a fantastic thing which the regulator has done. In early 2000s, this was not there. So suppose in the same category, I'm running, say, 3-year duration, somebody else is running 5 year, somebody is running 1 year. So when a retail investor looks at it, he will get confused, even if he's told that the name is short-term bond fund. But how short? Is it 1? Is it 3? Is it? Today he knows that this is the category, and it will not go beyond this limits. So that is how SEBI has segregated these products, and I think this is a very big achievement for the retail investors.
Yeah. Reminds me of FlexiCap, right? FlexiCap can put in large, mid, small, so a dynamic can put across the spectrum, right?
Absolutely.
Okay, folks, so that's the part on the basics done, and of course an introduction to LIC Mutual Fund. We are done with that. Okay, Marzban, we've just had the recent vote on account where I think the fiscal deficit number surprised quite a few people. I mean, I think it was 5.1%. So there's obviously a big focus on fiscal consolidation. A lot of people were expecting that there might be populist measures, etc., etc. And we still actually have the July budget to go. I mean, this was just a vote on account.
Yeah.
So let's start from there. Your view on this vote on account, the government general focus towards fiscal consolidation. Let's start from there.
So whenever there is a vote of account or there is a budget, what debt market looks for, one is the stake sale. If the government is selling any stake, from their kitty, because to that extent the borrowing program will come down. So that is one thing which people are looking at. At the moment, the markets are very ripe. Equity markets have gone up. It's a good time if the government wants to sell some stake. But considering the tax collections that they are getting, whether in terms of direct tax collections or GSTs, what achievement they have had, they probably don't need to sell at this point in time. So that is one part. The other is on the fiscal, which you just mentioned, which debt markets are interested in. So the target was 5.9% for this year, and it was brought down to 5.8. So basically, fiscal deficit is like, suppose if you have 100 rupees and your expenses are 120, so you need to borrow those 20 rupees to fulfill your requirement. So if you don't borrow or you borrow less, then it is showing that there is some discipline within you. Similarly, for the coming year, next year, they have talked about market expectation was 5.3 and they spoke about 5.1 because of the beyond tax collections that we are having. So in that scenario, the market was very happy because now it's not only about the local investors, it's about the global investors also. We have been included in the JP Morgan index and other indexes. There are talks are going on. So we are talking, we are trying hard to get some upgrades or, at the country level. So it sends a very good signal to the outside investors that we are disciplined, we are bringing down our deficit, the central government is working towards that. And that is why the market took to this kind of announcement very positively, and the yields also declined after this vote on account kind of.
So folks, it's important to understand the relation between that fiscal deficit number and interest rates, right? Because as Marzban just correctly pointed out, that if you are earning 100 but your expenses are 120, you need to borrow that 20, and that 20 actually comes in bonds. That's why bond supply, and when bond supply is a lot, obviously the value will come down. I mean, the capital values will be low, and if bond supply is not that much, it's better for the bond market, if I've understood it right.
Absolutely.
Okay, so how has the bond market received that 5.1% number, and what are the expectations generally on bond supply for FY25? I mean, I remember, say, 10 years ago, this used to be a major number for the bond market when things were still not as developed as they are now. But here we are, 1 year ahead, 5.1%. How are things looking?
So every year before the budget comes in, the bond market is busy calculating the supply and the demand side, both the sides of it. And this time the expectation was around 15 trillion, kind of similar to what it was last year. And when the government says that we are going to keep the fiscal deficit at 5.1, that means they are going to borrow less to that extent. This year also they are going to borrow 1 trillion lower. So to that extent, the pressure goes off from the supply side. As I said, before the budget or the vote on account, we do this type of exercises. So if we feel there is a 15 trillion kind of a supply, where will the demand come from? Say banking sector. Now, last few years, we have seen that the pension funds are growing in a big way. The insurance companies are going in a big way. So there is demand from all these sectors, which is coming for the bond, the GSEC supply. So supply was anyway, and when the government says that we are going to borrow less, that means it is a fantastic thing for the bond market. This is over and above foreign investors who are going to come and buy from June onwards. So just imagine, if your supply keeps getting lower and lower, and demand keeps increasing, what will happen to the
prices?
We just spoke about appreciation some time back. It will give a huge appreciation to the bond yields.
So now, given all that we've discussed so far, what is your view on the interest rate cycle?
So I'll just divide it in two parts: the short end of the curve and the long end of the curve. The short end of the curve is like 1 year, 2 years kind of thing that is more linked to your liquidity in the system. At the moment, RBI has kept the liquidity tight because your inflation had gone, was on the higher side. RBI's target, it's between 2 to 6%, so they just want to bring it to 4% so that they have the required comfort. So they are trying to do that. The last number that we got is around 5.10, that is close to 5%. So once that number comes towards say 4.5 kind of thing, RBI will have the required comfort, and then they will release liquidity in the system. At the moment they can't, because liquidity is again inflationary in nature. So that is we feel that once your inflation numbers come down, RBI will take the necessary steps maybe 2-3 months down the line. So that is the view on the short end of the yield curve. At the long end of the yield curve, it's about the rate cuts, which we just discussed some time back. So that may take some time. That may not happen immediately, because if we cut today and say globally rate cuts are not there, then it impacts the currency to that extent. So that's why the central bank will wait for some time, we believe. And once US starts cutting, we'll see some rate cuts here also. See, what actually has happened is we have not seen very aggressive rate hikes also over here. Unlike US, which was like at 0 and went till 5. So there the rate cuts will start, it has to start more faster. Here it won't be very deep, it will be shallow rate cuts. That is what we are expecting this year. But having said that, that is one part of the story for appreciation. The main part is about demand supply, which we discussed some time back. The more the demand, your yields are like, there has been no rate cut in the last 6 months, 1 year.
Correct.
But still your yields were at 7.5 and now they have come closer to 7%. So why has that happened? Because there is more of demand. People are building up positions.
Yeah. Okay, now moving towards the end of the episode, given whatever we've discussed so far and the fact that we are at a very interesting point in this rate cycle also. There's nobody who's calling the top. There's nobody, who's taking a very aggressive call of moving across duration or wherever. What's your recommendation or your general point of view to people who are listening to the show, how they should allocate the money into debt mutual funds? So I think one way to look at it is, let's talk about someone who's very, very conservative to someone who's very aggressive, someone who's more mature, someone who's sophisticated and understand this. What are the kind of products that you would be talking about right now?
So whenever I talk to retail investors, I always tell them that debt is for stability and equity is for growth. Always remember this. Whether you are aggressive or you are conservative, when you come on the fixed income side, you have to see your tenor, for what tenor you are going to be there in the stay invested, and what is your risk appetite. Accordingly, one can choose products depending on the duration, which we which we discussed. Conservative investors should be at the short end of the curve. They should not go beyond, say, a short-term bond fund, or say if they are less than 1 year, then they should be in the low duration categories or those type of categories. Aggressive investor can go into say a bond fund category or a gilt fund category or a dynamic bond fund category. And especially nowadays, a lot of things are available, a lot of data is available. When you are in a falling interest rate scenario, these long-term type of funds tend to give good returns. But at the same time, there is a lot of volatility also in these type of funds. So if you can take that volatility, then the aggressive investors can go there. But the conservative investors should be at the short end of the curve if they can't take the volatility. Only thing which we discussed earlier also about the SLR, the safety, liquidity and returns. We are not a big proponent of the credit as a category.
Yes, of course.
We don't push that type of products. People those who have the risk appetite, those who understand can go into that, those who have the patience. But we are not a big proponent. Sometimes people want to be very aggressive. So that time we tell them that there are hybrid funds also available. You don't need to take that credit risk at that. And you are not going to get a huge return by taking that risk. So for 0.5%, 1%, why would you want to take that? So go for a hybrid fund that will solve your query for an aggressive kind of investor.
So folks, remember what the sticker of the debt mutual fund says, and please read that carefully to understand what product you're investing in. What Mr. Irani just said was that someone who's conservative, it's better to be on the short end, a lower duration fund, and someone who's aggressive, who wants to play that whole interest rate movement. Then there's obviously stuff on the longer side, gilts and things like that. But credit is something that they are very cautious on. I just realized, Marzban, that LIC Mutual Fund was among the earliest, or at least you said 10 years ago you had a passive product in debt.
Yes.
So what's been happening in the passive side of the debt mutual fund industry? Can we just talk about that, because it was something that had held a lot of promise at one point of time.
So passives is a big revolution which is happening globally. Passive products are very active, and I think here also we have seen passive products now catching up. LIC had launched one scheme a long time back, around 2014, on the fixed income side, because on equity side there are many funds which have been launched earlier, but on the fixed income side, it was very early, I would say 2014, around that time. So those funds are very good for retail investors, because what is the index all about. The entry exit is there. There is a market maker who will give you a two-way quote. And in a normal fund, if you say invest in the morning, you will get the day end kind of a NAV in a bond fund or a gilt fund or anything. But when you are in a ETF, it's more of a live kind of you're getting that live NAV. Yeah. So you are able to capture the market at that point in time. So it is a big thing which is happening. Expense ratios are lower. And as we go ahead, some allocation has to go to these type of products going ahead.
Sure. Okay, we are done with the show. My last final standard question to all our guests is, any book recommendations that you're either reading or had read, or something that you would like to share with the listeners?
I normally tell people to read Intelligent Investor, Benjamin Graham.
Obviously.
Because he tells you to stay invested for long term, then you can create wealth for yourself. You can make, good capital appreciation over a period of time instead of any short term gains. So, but otherwise also I always tell investors that keep reading whatever you like, daily for some time. That would, stimulate your mind and give you some ideas. And, reading is always helpful.
Lovely. Look at what a great message, folks. The habit is more important than the book. But if you have to read a book, there you go. Intelligent Investor, a classic by Benjamin Graham himself. So that is a wrap on this episode of Paisa Vaisa. My guest, Marzban Irani, Chief Investment Officer, Fixed Income at LIC Mutual Fund Asset Management. First time on Paisa Vaisa. Marzban, thank you so much for doing this for our listeners.
My pleasure. Thank you very much.
Thank you.
IVM.